I didn't really think that I would live to see a world when, a president of the United States would say that we have been ripped off, we are the victims.
Now, he can say what he wants, but what he's really saying is, I don't want to keep funding these trade deficits. Now, as a government, it doesn't help you. The world isn't voting for you. What's really happening is your voter base, and therefore you need to do what appeals to your voter base.
Sketch out this view of our deficits, good, bad. How is this entire thing structured?
The thing is that even for the US to succeed in its policy, it needs a weaker dollar. What the US is really trying to do,
if you were to put your advisor hat and give advice to somebody who wants to allocate his monthly savings, monthly surplus into the capital markets, what would you tell that person?
So I think
Hello everyone, my name is Bhuvan and thanks for tuning into this episode of Please Help Me Understand. I initially started this show because a lot happens on any given day in the global financial markets and in the global economy. And a lot of it goes over the heads of the average people. And the fact that even if you listen to experts and people who are knowledgeable about things, they tend to use fancy language, jargon and fancy words, and all of it seems like Greek and Latin to most of us, including me. So I figured there should be some show where the host was comfortable looking dumb and stupid and ask all the basic and simple questions that most common people tend to have. And so that was the idea behind this show. It was to ask the dumbest questions to the smartest people in the financial markets. But for a variety of reasons, the podcast took a backseat because we were trying to do a lot of things on Zerodha markets, and I couldn't keep this podcast going. But considering whatever is happening in the global financial markets, as I record this, I figured now is as good a time as any to restart the show. So, to just give you a sense of what I mean by that, I recorded this podcast on April 7th, and on that day, the Nifty was down, 3.2%. Small and mid caps were down by about 3.5 to 4%. But there was absolute carnage and mayhem in the global financial markets. In the week before, the US markets closed down 5%, but on Monday, the same day I recorded this episode, Hang Seng goes down about 15%. Nikkei, the Japanese stock index, was down about 7%. The Chinese markets also closed down by double digits, if I remember correctly. There was also widespread declines in the Middle East. So it's just absolute mayhem wherever you look. And the nominal cause for all of this was, of course, the tariffs imposed by Donald Trump, the absolutely brutal tariffs imposed by Donald Trump. So, to understand what was happening, I went back to the previous guest on the last episode that was on this show, Debashish Bose. He's a portfolio manager, and he's probably my favorite go-to person to understand anything big that happens in the global financial markets. For example, the last time when that entire drama around the yen carry trade was unfolding, we recorded that conversation to figure out what was happening. So in this conversation, we figure out, what do these tariffs mean? What's the context in which these tariffs are happening? What does it mean for the Indian economy, the global economy? What does it mean for the global financial system? What does it mean for the dollar-based global financial system? And so, and what does all this mean ultimately to the portfolios that you and I hold? So it was a long marathon conversation. It was absolutely stunning because I learned a ton and I had a lot of things to take away and think about. And I hope you enjoy listening to this absolutely brilliant conversation as much as I did recording it.
Okay, Debashish, thank you so much for doing this again. I think so. I started this podcast with the idea of doing exactly this, but then a variety of things happened, so I never really got around to doing it. Coincidentally, the last conversation was whatever conversation we had. So in that conversation, you kind of gave a flavor of a lot of the structural changes which were kind of gathering pace. Be it, let's say, inflation, be it spending, be it the importance of governments over private capital allocation, so on and so forth. And since then, I think a lot of those trend lines which you drew have arrived at an inflection point thanks to Trump. And, we are at a point when most of the Indian broad indices are down 20%. Nifty 500 is at, I think, 18%. But the equal weight indices, they're all in mid cap, small cap, micro. They're all in a firmly bear market. The S&P 500 is seeing moves like it's the Great Depression already. I think it's making 2008 look like a cute correction. And frankly, I don't know. Like say, I've not seen the 2008 crisis. My first introduction to a reasonably severe crash was 2020, but that in hindsight seemed like a blip. But this time it genuinely feels scary because on the one side, the Indian market activity, liquidity, however you measure it, is evaporating. At the same time, any reasonable indicator of either policy uncertainty, trade uncertainty, financial, whatever uncertainty you pick, is just all of those indicators are going to the moon. So before we get to the details of what's happening, just sketch out what's happening in this moment right now, and we'll get to how we arrived. But as you see it, as you see the world, what's happening? Like just help us contextualize this.
Sure. Thanks. So yeah, I think as you alluded to a little earlier, that there were a whole set of things which were already in play. And I think some parts of it, which we talked in that marathon session we had 7-8 months back. And what Trump has probably done is just basically accelerated all of it. So the timelines are probably getting crunched. If we had, and this is a topic we'll elaborate a lot more when we talk about it, but if we had thought that maybe there's a reset of the financial system, we'd hinted at all those things, currencies, all those things, if there's a bit of a reset of that happens maybe over 15, 20 years, chances are now that timeline has just got crunched to, God knows, 5 years, maybe.
Right.
I mean, no one truly knows, but definitely it's got crunched. So that's I think the starting point. As regards, the other point you touched on, it's probably a first severe correction and all that. Let me put it this way: it's a bit of a prolonged correction,
right,
compared to say March 2020, which was like a month, and like if you had gone for a holiday that month, you would have missed that anything even happened.
It was a quick snapback recovery.
Yeah, exactly. So this is not that, and
it's grinding down.
It's grinding down, and I think it would be wrong to blame the fall of the Indian markets on Trump. I think we had been falling for a good period even before that.
Yeah. We started in September.
So there are probably a set of reasons for that, which we can get into in a bit. But that should also be kept in context, which also means our recovery cycles may not match. But what even happens? What's a recovery? I think that's another part we'll sort of get into. And just to elaborate the part you also made about the 2008 fall and how it felt and all. I did sit through it. I did sit through the 2000 fall as well. This to me seems closer to 2000, not so much 2008.
Okay.
Because 2008 was severe. The excesses were quite a bit. I think the excesses even this time are, but it was a period where the excesses were all over the world.
Right.
In, of course, the US, the excesses were not so much in the equity markets. It was much more in the whole derivative and, bond complex. But in the emerging markets, it was all over emerging markets. Even other international markets were like all, guns blazing, commodities were all through the roof and all that. The economies were actually roaring at that time. So nothing of that sort has actually been happening. I think why it's feeling maybe a little more painful is one, I think the sheer penetration has increased significantly than what it was. And I think if you just look at any of those metrics on the number of shareholders in any stock and see how that has shifted in the last 15 months maybe, and you can see, it's a 3-4x increase. And that's, I think, what is, I mean, the other side of it is, being in the business, maybe as long as I have been, but even, the other people in the business. Today, you don't need to tell a person to look at equity markets, if you know what I mean. It's like everybody is already in. Yeah, it's already in. It's part of mainstream pop culture as well,
Absolutely.
Comics refer to it as well. So then it's natural that if it's been broadly a good time for the last 4-5 years, I think a couple of years of pain are sort of par for the course. And that's where I'm equating it a little more to 2003, that period where the peak of the fall, I mean, the bulk of the fall maybe happened between 2000 May to 9/11, that 15-month period, whatever had to fall. But then there was a good 15-18 months post that where the markets didn't really go anywhere. They kept grinding down. So that's the period which sort of wears you down. You just sort of lose hope and all that, and the participation reduces dramatically. I mean, Nitin's been talking about it all the time anyway. So
He's been right 10
Yeah.
times in the last 15 times.
so so I think that's I think where we are. But that's just to set the context. But of course, what's really going on? I think let's not make any bones about it. There's a massive shift which is underway, and we can sort of get into the parts of it whenever you like.
Got it. But before that, so I think in the moment it's very easy to confuse this for a Trump-led fall. But at the same time, people tend to forget that this thing started in September, like you pointed. Like if you were to just pick 5 random reasons why we started early in the race on the downward journey, like what do you, like is it a valuation reset? Is it a correction? Is it market say it answered? I don't know, X number of random reasons. Because the backdrop against which the Indian market fall is also happening is because we've had 5 phenomenal years. At the bare minimum, we did double to triple digits across different sectors.
Yeah,
like,
I
is
think
it just
barring 2025, everything else
even
was
then we were
right.
flat in 23 when the US was around 30%.
That's right.
So that was ridiculous. So is this just a lull period after 5 good years, or to your mind, are there any structural reasons why the Indian markets had to see this downward journey?
No, that's excellent question. So yes, there are reasons, of course, but I think the first thing at a very, very basic level, most of the money came in from the domestic investors in the last 4-5 years, which means you sort of have to weigh it against the cost of capital for a domestic investor. And that's something we talked about, I think, in the last time also, that what are your alternatives, right? And what had just happened was you had equities priced at whatever 23, 24 times earnings. Flip that around, that's the equivalent of about 4.5% yield. Okay, and that's sort of the yield which people have earned on their FD returns. So yes, that whole thing can go on till it goes on, and that's sort of what was happening. But if you just looked at where we were in terms of market cap, total market cap to GDP and all that, we were sort of already pricing in where our GDP should be by 2027, 28, by last year itself. So we were about 4 years ahead, right? And for us, I think market cap to GDP is a good enough metric. Yes, sure, you can give a little premium to whatever, 1 time is usually the norm, maybe say 1.25 times or something at max. But it's not too much more than that, because we're not an international economy by any stretch. We're very domestic like that. So that's another thing which meant that if we've already priced in 3-4 years ahead, and if something changes, and the something which changed was obviously this election and the way the government did not get the majority it wanted, which meant that yes, coalition politics would play and all that would come in. And if a big driving force behind the economic growth out of COVID had been government spending, so then, which is actually not that different from the US also. VC spending and government spending probably is the big...
Yeah, more or less fiscal-led rallies.
Fiscal-led rallies. So even here it's been that. It's been either government spending or VC spending, which has sort of driven things around. So then that, makes for a slightly dodgy scenario if those start slowing down, which has probably happened in both sides. Both the government spending and VC spending has slowed, which means activity, it was always... So what's your growth activity is unlikely to be as fast as what it was in the next few years. It doesn't mean it's going to go off completely, but if it's unlikely to be, then maybe if you're pricing in 4 years ahead, it's a bit rich, right? So you would have probably had either a phase of nothingness for 4 years, which may still be the case. We may ultimately end up like that. Or there is a sharper correction and things come back into, some sort of line, and it goes from there. Now, even headed into Trumpomania, if one were to call it that, and after, say, an average of 30% fall across stocks, and never mind taking the last earnings, I mean, if you just take sort of like a cyclically adjusted kind of earnings over time, you were still not really cheap. You were still priced at 20 to 30 times, take your pick, for the normal sectors, and for the stuff which has usually been defensive, probably 40, 50 times still, right? So, which means that we're not really in the territory even of March 2020, where things were probably down to, low single digits, low teens, or April of 2009, we were down to literally 10, 11 times, if I recall correctly. So we're not there. We're not really there. So which always leaves the scope that any shock can, impact the markets. They probably just needed a reason to go down. Of course, in this, we can't say that, this last week or so is not necessarily India alone. I think the only bizarre one was why had it not fallen more on Friday itself, where everything else was already, getting shaken out. The US probably needed to fall, and that's probably happened. Where I think there was a nice Scott Bessent clip which has been doing the rounds, where basically he says it's not really a US whatever problem, it's really a Mag 7 problem. If everything is in those 7-8 stocks, of course you have a problem.
It was even worse. He said that, correction is a financial market problem, not like a real estate problem.
No, which is exactly where he's getting at. Now, of course, for India, what has just happened is financial market has become a little more Main Street on the margin.
Yeah. So there's a noise element.
Yeah, the noise element has grown, and lots of people have been part of it and everything. And things have fallen across the board, right? Stocks have fallen, even Bitcoin's fallen as much. So in a way, whatever you were in has probably taken a bit of a knock. And then, of course, you add in the leverage positions. I mean, back in the day, it used to be margin funding that's got basically replaced by,
So
high
it's gone in different ways. There is MTF now, there is leverage inside structures.
But just F&O, basic F&O itself is, on that. And then when you're suddenly dealing with scenarios where for extended periods, the VIX or whatever metric one uses to measure it stays relatively docile, but then suddenly it spikes. You're going to get those gamma unwinds, every now and then. So I think it's a bit of that, but
Got it.
that is what it is.
We are recording this on April 7th. So
Yes.
we are, it's a 4% day for Nifty. For the broader markets, it's worse. Small caps are down, I think, last time I saw 6%. So now, I think since September, roughly 25th, 26th, whichever date you want to pick, we peaked. And then we've been grinding down steadily. And as this was grinding down steadily, this happened at a time when F&O regulations took out a lot of leverage out of the system, which also meant that you had knock-on effects in terms of participation leaving cash equities. Surprisingly, the SIP flows kind of more or less remain the same, but people were leaving. The direct equity participation was just falling off the cliff. Pick your metric, we were down 40 to 50% across the board. And then which brings us to April. Now, as those domestic factors which you mentioned, earnings growth slow down, being fully priced, dragging the future returns into the present, as all those India specific factors were kind of being digested by the market, we are now getting dragged into this global maelstrom. So Trump has put 10% across the board tariffs, and he used ChatGPT to pick another fancy number and slapped a ridiculous amount of tariffs for all the major countries, 35% for China, 26% for India. You take your pick. So last time when we spoke, you were kind of hinting at saying that this is an inflection point in the sense that things have to change, because the traditional narrative is roughly for the entire post-war period, the entire world has been anchored by this one global hegemon, US. And also, pick your story. Either the US decided to make dollar the global hegemon, or private actors chose dollars as the global funding currency. The story is yours to pick. So then we have been anchored in this system. And then 1990, roughly, China starts coming onto the scene. And then that unique moment of unipolarity became slightly multipolar. Russia was more or less a sideshow, even if you disagree. So now we are in this moment where there's a rising superpower, and there is the incumbent superpower which is trying to kneecap the rising superpower. And at the same time, the political winds have shifted. This entire liberal outlook towards the world now seems anathema. Right wing. I don't mean that in a pejorative sense, but right wing thinking is predominant, and these people. There's a certain historical grievance thinking that they got the short end of the stick for the last 40, 50 years. Liberal technocrats sold us a dream saying that if you stitch together world, if you ensure there is free trade, if you ensure there is free mobility of capital, labor, whatever, blah, 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 you are going to get the best of all worlds. You're going to get cheap goods, cheap services. Your middle class dream will come true. It didn't really happen for a large chunk of the population. Now that population was disenfranchised in the loosest sense of the word. They didn't really have a voice. It was more or less plus or minus 5% here and there. It was center right versus center left. But now that seems to be falling apart, which brings us to Trump, and he's giving voice to the people who kind of didn't have a say in how global economy, so the global economic superstructure kind of was constructed in the aftermath of China joining the WTO. And now the weirdest thing is US is playing the victim card, which was, I didn't really think that I would live to see a world when, a president of the United States would say that we have been ripped off, we are the victims. And the solution for that historical injustice, as he perceives, is slapping tariffs to correct the fiscal imbalances, trade imbalances, etc. Set aside the sort of the economic innumeracy and illiteracy of his logic, but nonetheless we are here. It's what world I want is immaterial. It's a Trump show right now. Sketches, give me a sense of what he's trying to do, or rather how you see what he's trying to do, because he has given multiple reasons. One, it's fentanyl. Two, it's trade deficits. US debt bubble is about to explode. Three, countries have higher tariffs than US. They're trying to rip us off. Four, it's China. Because all of these things they don't go well together. So to fix all of those problems, you need different tools. But he's using tariffs as a single cudgel to fix all the problems that US is facing. What do you think? How do you read the Trump moment?
And for that, we probably need to do the backstory, the whole preamble, and then get into all this. And if you recall, there was a term we had used quite a bit during our previous talk, which was deglobalization. And I think that's just what's got accelerated. And you could use the word national capitalism to sort of refer to what is basically transpiring now. But let's step back a bit, because otherwise it gets more complicated to look at now without looking at the historical context. So if you just look at the system broadly in place since, say, post-World War, effectively, was where the US essentially was like, I will, with the dollar as the reserve currency, the gold peg had anyway ended, all that had happened. So with the reserve currency, I'll basically finance trade, right? Which means if you are a supplier of products, whether it's the oil complex or it is the manufacturing complex, which in those days was, Japan, Germany, later moved to Korea, Taiwan, and now, China post the 90s. So any of those. So I'll basically finance it. It's essentially another form of vendor financing, if you were to put it that way. So they will, produce those goods. Obviously, the orders will come from the US companies and maybe the European companies and so on. And then those goods get sold back wherever. Initially into the West, but then as other markets also grew, basically they were sold everywhere, right? It's just that the transactions were all happening in dollars, which is still the case. The dollars were then accumulating with someone, right? And you could say accumulating with both sides, which is the exporter who's selling the product, he accumulates it, as well as the buyer who needs it. Like us, we need oil, we can't help. So we will accumulate dollars to pay for our oil, not counting what we may get as exports as well. So the money accumulates. But where does the money accumulate? It's lying in dollars. So basically it goes right back into the US in the form of basically investing into US bonds, and then maybe also to an extent into other assets in the US. Okay, but financial markets in the US. So essentially what you're doing is you're running your trade deficit, but you're actually running a capital account surplus, okay, because you're taking on the reserve surpluses of the rest of the world. So we had talked about this bifurcation even in the last one, where we said, what is a reserve currency? There is a reserve currency for transactions, and then there is reserve currency as a reserve asset. And that bifurcation is what I'm sort of referring to here. You do the reserve currency transactions and you accumulate the assets which come up. What Trump is really doing is breaking this chain. Now, why this is, and there's a whole link to it, because this chain, what I described, is only the economic system. Goods being produced, energy and matter, basically. Energy and matter being produced and traded around the world. Okay, but you accumulate all these reserves and you are buying US bonds predominantly with it. You could be buying other bonds also of, the German or Japanese or whatever. Then comes the link from here into the financial system, the global sort of money system, if you were to call it that, which is these bonds then serve as collateral for the entire derivatives markets. And the derivatives markets post 1990s, when they repealed that Glass-Steagall Act, essentially took off. So it was not just about, okay, the money is so much and therefore money supply is so much and therefore goods which can be traded can only be so much, which is basically your credit line is so much. You essentially just took those bonds and enhanced the credit line 20-fold. So the net result of all that was, if your real economy or real stock market, which sort of reflects the real economy, the cash equities reflect the real economy, is roughly about 100 trillion, give or take. Somewhere, but then your financial system with your complex of bonds which act as collateral, and then the derivatives on top of it could be a few quadrillion dollars and nobody truly knows, right? You're breaking this now. Okay, so let's let that seep in for a bit. This entire financial edifice is what is getting hit directly. Okay, because now, he can say what he wants, but what he's really saying is, I don't want to keep funding these trade deficits, right? Which means I don't want to keep doing vendor financing. Now, if he does not do that, the exporters do not accumulate as many dollars. Okay, the person who needs to buy anyways now starts searching for dollars because the dollars moving around will reduce. And if that's happening, then not as much of buying of US bonds is happening. Sure, some of the bonds in the last 3-4 years, instead of bonds, people were buying stocks and using that to leverage. So basically, debt financed collateral became equity financed collateral.
Which is 2008 great again.
Yeah, so which is part of the reason why also, the Mag 7 is taking, or whatever, that piece is taking a bigger hit. But the reality is, what he's basically saying is, don't give me money in my capital account, or rather into the financial market side of the capital account. If you have to put in money into the US itself. Okay. So direct FDI, basically replace FPI with FDI. That's what he's saying. But that sort of completely changes the way the world has worked for the last 40 years.
Absolutely. Before that, so we'll get to the financial implications, because I think to my mind, the potential unraveling of the global financial system, as we have known and gotten used to for the past 2-3 decades, is a far bigger deal than most people anticipate. This isn't to minimize the real economic impact, but the justification that he's giving is saying that since pick your period, since the post-war period, the US has essentially kind of been a victim, and it has run persistent trade deficits to finance the surpluses of China and the rest of the world. Now, there's a bit of a causality issue here. Is the US running a trade deficit by default or by choice? Which goes back to the question of is it really exporting those US dollar assets, which the world so desperately demands, or is it the other way around, which is that US is consuming so much that it has to finance its deficit some way or the other, and it just so happened that the world was in need of dollars, and then this arrangement conveniently happened. So in all this, the implication is that deficit is bad. So it's become like a very monocausal reasoning, saying that you have to run surpluses at any cost. If you're not, then other people are ripping you off. He also tends to forget that US runs $1.5 trillion services surplus. By that logic, the rest of the world should be imposing tariffs on US services. Not that it is
probably easy. Which is probably coming next.
Yeah. And set aside the question of whether the services are really actual services or tax dodging, the Apple, Ireland, this thing, etc. But just that, how do you understand this entire issue of deficits being good, bad? Because ultimately all of this have to net out at some level. He's attacking individual bilateral trading partners and trying to balance those accounts, but then that necessarily means something has to shrink somewhere. And I don't think people understand the concept of deficit. And people say that it's like deficit is like borrowing from your bank. It's bad. It's a very myopic kind of reasoning. So just sketch out this view of are deficits good, bad? How is this entire thing structured?
So again, one part is the historical context. Let's do that. And second part is the narrative, which I'll come to in a bit. The historical context is when these things were put in place, post-World War. The US was a significantly bigger part of the world economy. So and this whole financial edifice did not exist. Anywhere from the Middle East to your Chinas of the world and Japans of the world did not have surpluses. Okay. So at that time, you needed to essentially extend construction finance to them. And of course, US companies benefit. Yeah, basically, US companies benefited from all that. They bombed the place and then they benefited from it. So, and of course, with their all, treaties which they put in place, there was that militarization part which was in the hands of the US, but then the industrialization part which was handed over to the Germans and the Japanese and the Koreans and Taiwanese and all that after that, right? Now, but subsequently, the rest of the world has grown. Earlier, the other developed markets, and now the emerging markets. And of course, China has become humongous. Okay, which means the US, which was maybe 50% plus of the world economy, is now about 25% now. And that is after an increase in the last 5 years. It had actually shrunk to about 20% of the world economy. Right. So now, in that scenario, and that was a great question you asked, that is it the need to finance deficits which is the problem, or is it the importing which is the problem, which in turn, or what is the thing? And it's that classic chicken and egg now, because the whole Jenny's out, and it's such a big piece which they effectively have to keep financing, and that's really where they're sort of putting up their hands and saying that, look, we can't keep financing this forever, because the rest of the world is growing. I mean, like it or not, it is growing. And we haven't even really seen the growth of the emerging markets in its entirety yet, ex-China. I think that piece is still expanding. So you cannot keep running that size of deficits and all that throughout effectively to be able to lend the dollar assets on the other side to manage people's reserves. So you could almost say, just to manage the reserves, they're needing to do this. I mean, that would be the argument they would present from their side. Of course, the argument from the other side could be the opposite. So depending on which side of the table you are, you could have that view. So that's why I'm saying, yeah. So that's why I'm saying it's your classic John Soros reflexivity, A, B, whatever. But what the tariff thing, and that's where I'm coming to the narratives. Now, how do you go explain all this to people? It's just impossible for people to understand, right? Your objective anyway is to make people, or rather to make the flows shift from coming into your capital markets and therefore not wanting to be the reserve asset provider, and instead having it actually coming into the real economy and creating those jobs and all that, especially in his main vote belt. Okay, so that's simply what he's doing. And as any astute politician, he has figured that you don't need to, you need to have the right messaging for the audience which is going to vote for you. Like, what is his target? 18 months out midterm election, right? That's really what the rest of the world thinks is not really his problem, right? So that's where we are. Okay. Now, we had to go down this path anyway. And for this, let's step back to what we had spoken about, that whole financial repression concept. With the size of the debt which is there all over the West, there is really no way out but to, undertake financial repression, where you keep your bond yields artificially lower than inflation.
Got it. Also, I'll just pause you 1 second. And this is at a time when we also have humongous amount of spending needs, be it in terms of, the current chips race, where you have to, onshoring, friendshoring, reshoring, whatever inequality is in vogue. Plus, there is the entire amount of the entire spending required for the green transition. Plus, there is a potential possibility that inflation might be structurally higher. And financial repression, as you mentioned, is potentially starting to unfold against this bankrupt. Sorry, please continue.
No, that's exactly right. So those are just ways to make financial repression happen, what you just enlisted. But essentially, you need that. You need that to work through that debt. You issue bonds at 4%, you have inflation running at 6%, so you basically take away 2% from the saver throughout. That's your strategy. And if you look at what these tariffs will achieve, you go back to what COVID was achieving was exactly that. What the Ukraine war was pushing the world towards was exactly that. What what Trump is now doing is exactly that. And all of these are fiscal policy driven. Monetary policy is really not that material anymore. So we basically need to forget about this, this whole clamoring which keeps happening for reducing rates. It doesn't matter. It's not going to change too many things on the margin, right? This is a fiscal driven world. Governments are taking the shots, and you sort of align around that. Now, as a government, it doesn't help you. The world isn't voting for you.
Right.
Unless all you're interested in is the Nobel Peace Prize, the world isn't voting for you. What's really happening is your voter base, and therefore you need to do what appeals to your voter base. Okay, and that's really what is national capitalism. That's where it comes in. Now, let's look at it again in this context. What is he really doing? He's saying, okay, you want to come to the US, you want to work in the US, set up your own, factories here, set up your own manufacturing units here. I don't want you importing in it. I want to import the actual manufacturing facility here rather than just your money coming into the financial markets. Okay. The second side is, the reserve currency provider has almost always been also the security provider for the world, the global policeman, if you will, which again is expensive because to keep doing that, sustaining that at a time when your interest rate payments on just your repayments are higher than your defense budget. So it's a clear problem, right? So then obviously they're saying, okay, let the others pay for the defense. And if not, let them go, build their own defense for themselves, which could also translate into some benefits for US companies as a result. And that's exactly where we've gone. What Germany basically came out and announced, and that too from the incumbent parties who were facing all those issues from the AFD and all that, is essentially something of the order of 5 to 10% of, 10 to 20% of GDP is what they're talking about. Right? And things which Germany has not done in 100 years.
That was ridiculous.
Yes, that's what they're talking about doing, Now, whatever Germany has done. Now, if suddenly Germany starts militarizing, the one country for sure which will do so as well as France. France never really demilitarized, to be perfectly fair, but France is the one which has got oppressed by Germany on multiple occasions.
Yeah, so historical rivalry runs.
So that it will. Same holds true for Italy. Same holds true for the UK. Same holds true for the Scandinavian countries. Right? They all go down that path. Whether you blame Putin for it or whatever, it doesn't matter. It's all going to go down that path. If you look at the post-war trajectory of both Japan and Germany, they've been almost the same. Even the whole reparations and all that which were put on them were quite similar. Okay, their industries, the makeup of the industries is very similar. Now, what's interesting is the European companies or the Japanese companies, and of course the Chinese companies and so on, are actually very well placed in a world where everyone's trying to build things. They are industrial companies. They have the IP. They are, they're sort of the NVIDIAs of the industrial world, if you want to put it that way. Also, project finance becomes a very important thing as opposed to venture capital. When you're talking about this kind of remilitarization, reindustrialization kind of thing, which again is an industry where the whole banking, insurance setup, especially in Europe, has always been, or Japan has been very geared towards project finance. So the only thing which is changing is the government now directing it, and the natural fallout of this is governments urging their own industries, their own companies to invest more locally, everywhere. Okay, and maybe even putting barriers to them putting money outside, which is essentially capital control. That is what we've had. Because what can go wrong in all this is that you're not able to execute, you're not able to build, and at the same time you put all those tariffs from your existing suppliers. So inflation starts going up a little too fast. Okay, and all your grand plans of keeping the yield under control goes out of whack. So then the first step you do is you do what Japan has been doing forever and sort of gone nowhere, yield curve control, and then you put capital controls, and you maybe put price controls. So you mix these three together. I mean, in India we've always dealt with all this, but or in general in emerging markets has always been a story. But you mix all this together, so then it's national. I mean national, but capitalism I would put as quote unquote. It is a different version of capitalism.
Attached.
Yes. There's a lot of conditions attached.
So, I'll tell you one narrative of why this may not work out. So, I want you to poke holes in it. So, if you look at manufacturing as a share of US employment GDP, pick a metric, it was going down even before NAFTA. There was this one chart doing the rounds on Twitter. There are nuances with it, which let's set that aside for a second. So even before this entire era of free trade began, even before deregulation took off, really after Carter, Reagan, etc., manufacturing was going down, and this is partly attributed to I think Paul Krugman mentioned it. So it was the rise of technology and increased productivity, which meant that companies were generating more yield per employee with technology adding the rest, than with probably a mass of this thing. So which means that that entire manufacturing as a share of US hit, I think it was at the peak 15% or something like that. Now it's about 8%. Now, and the second thing is, this also happened at a time when China provided, the largest base of cheap labor the world has ever seen. So if the US were to reshore all of this, like let's say, for example, they slap tariffs on Bangladesh. Now, if US wanted to make cheap t-shirts, Bangladesh is paying probably $2-3 an hour to the laborer. But in the US, you have to pay at the bare minimum 7. Set us at 10. Is it really feasible for the likes of US, and I don't know where the Europeans stand on this, is it possible for them to onshore everything that they want? Because it doesn't look like it. Probably the CHIPS Act was a better way of doing onshoring only the critical elements that were necessary for the future, which is essentially semiconductors. And that probably seems to be working reasonably well. TSMC, etc., committed to building plants in Arizona, etc., and they're close to starting, production of chips. But for US to start making a spatula, which costs $2, and when the labor per hour is $8, how does this even work?
No, you're right. So let's put it this way, that the initial announcement of tariffs is a start, right? It's just like putting a marker out there, like throwing a dart out there and then, negotiating. No. So chances are maybe the whole tariff thing on Bangladesh, what we just referred to, may not actually stay that much. It may sort of come down significantly and all that. At the same time, it would still be something. So maybe they arrive at a level where it is feasible enough for the Bangladeshis to keep supplying it. But it does not impose too much of a burden on the consumer over there, and you still have all that. I mean, the fact of the matter is clothing prices have gone up there irrespective. So that's one part. Now, whether they'll truly succeed in all forms of manufacturing, or whether it's the US, whether it's Europe, is anybody's guess. Okay, no one truly knows. In the because as I say, sequencing matters. In the context of sequencing, at the moment, it is like our 2021-22 claim of we will become part of China +1. Okay. Now, reality has shown we are nowhere close to being there. Okay.
Absolutely.
And we're not even probably at China +20 at the moment, the way we're looking. So the reality may work out fairly differently for 3, 4, 5 years down the road. Okay. What I think they will definitely be doing is massive amounts of automation in factories, which does not necessarily solve their labor problem. I mean, of course, this is there's a huge labor problem to start with, which is also not the case at the moment. Okay, it's not like unemployment is particularly bad or anything, but
the labor market is tight. Plus, they want to undo the immigration, which potentially makes the matters
potentially, makes it more feasible. So I think one way or the other around the world, universal basic income upgraded to universal ongoing income is coming, whichever way we slice and dice it. But you'll have, I think, robotic automation will play a big part. I mean, there's no doubt about it in terms of, and I think, again, China's super smart there. They've already sort of significantly ahead of the curve in that. I mean, maybe there's hidden stuff in Japan as well. I don't know it as well, but they've been working on robots longer than anybody knows, on these things. So I think those pieces will be there. Ultimately, of course, they will want to make sure that the critical parts are made there. And it's even possible, they've hinted at this, that, we don't have the ammunition to go keep fighting a war for a while. The Europeans talked about it as well. And that may be the opportunity for people like us to step in. I mean, we're making bullets. It's not high-end stuff, right? And that's the kind of stuff we could probably make and give it to that. So it may be a bit of a hybrid of mostly onshoring, but a little bit of friendshoring and all that. But then for you to participate in that, you've got to, sign up those bilateral treaties and basically pledge your allegiance to the ring in these cases. So I think that's what may ultimately transpire, but that's anyway a problem 5 years out. From our context, what really just happens is that you suddenly have multiple countries around the world competing for the same industries. This has never really happened. Where you have post-industrial countries, the likes of the US, Germany, Japan, etc., industrialized countries, which is your China and maybe Southeast Asia and all, and pre-industrial societies like us, okay, who are all competing now to get a share of the same industries. Okay, and that's, again, it's something we just don't know how that's going to work out. Okay, so of course you've got to pick your spots and figure out, what we can, what we don't, what we need. They're putting in a lot of restrictions on shipping as well. I don't know if you got that news, where basically he said that if you have a Chinese-made ship in your fleet,
Oh, yeah. The shipping prices in China are crashing. I just saw it. Yeah.
there's extra tariffs which come in. Now, the reality is the 50% of the ship building is done by the Chinese. So any ship which is less than 7 years old, typically your fleets are 7, 8 years is the maximum you usually have, will have Chinese ships as half of it. So then you add your Panama Canal and also what I think they're trying to do with the Suez Canal and all that as well. So it's all rent-seeking activities basically, which will go back to financing things.
Somebody made a funny comment saying that he's running this entire show like a mafia don, saying that I'll give you security, you pay me your.
Yeah, pretty much. That's exactly what they're doing, because the reality is they also need money to finance their side of things, their deficits, their get things going internally. I think they're essentially just becoming more inward focused, and you can't really fault them for that. That's exactly what they're doing, and every other country is going to go down that path.
So that brings me to the previous point which you made, the state capitalism. But essentially we have been in this sort of weird pause where the prevailing consensus was that we are better off subordinating decision making to the markets, let prices set everything, including policy. And the way that governments kept their legitimacy was saying that, look, we have our hands off the steering wheel. It's the markets. It's market setting the policy, prices, blah, blah, blah. People call it neoliberalism, libertarian, whatever you want to call it. Pick your labels. Now if Trump gets re-elected, this thing is dead. We don't know what happens if he doesn't. But setting that aside, now we are back to an era where industrial policy is in vogue. That entire dogma saying that the government should be in the business of picking winners is all but dead. Everybody, including Indian government, US, Europe, they are picking their national champions, national winners, whatever you call it. Now, we are in this stage where, no matter how you measure it, global debt levels are at record levels. US is running a massive deficit of around 7 to 8%. The number boggles my mind. Countries like India, etc., they can't really borrow much more than they have been. In fact, they just have to rely on whatever limited pool of domestic savings they have to. Europe is now going the other way. They're trying to loosen their fiscal restraints, which they had imposed on themselves. I'd argue it was a stupid thing to do in the first place, but now they're trying to see, like, in a time when you're at a starting position, when you have very limited fiscal room, but unimaginably high spending needs, thanks to military spending, green transition, reshoring, onshoring, whatever you call it. Even yield curve control, financial repression, is that enough? Because to my mind, it doesn't really seem enough.
No, you're talking about US or you're talking about
let's start with advanced economies first, and then we'll move to emerging markets. Where will the money come from for all this unimaginably high spending needs?
No, look, I don't, but that's exactly what they're trying to do with that policy, that, essentially direct money into the country. They're also trying to free up a little bit of it by Doge, so that you reduce the basic government spending and sort of, it just gets a little more efficient. Look, capital can come. I don't think it's just about redirecting capital. What they're really saying is, don't invest in the financial economy, invest in the real economy. So redirect capital towards the real economy. And essentially, by real economy, their definition of it is more, the basic build stuff kind of thing, right? And this has also been doing the rounds that, yes, you want to set up these factories and all, but we then need to really strengthen our steel industry and all of that. The same narratives one hears here is exactly what's sort of being talked about. Energy production getting upped. Never mind energy transition, that'll happen whenever it'll happen. But I think just drilling more, I think all of that, energy and resources, right? That's always the critical part of anything. And then where you lack it, acquire it. Greenland, maybe Ukraine, sort of go and acquire all that. And then comes the logistics, which is where Panama Canal, exactly where it comes in. So
choke points
and just, controlling that, sort of being, getting the tariff for it. So I think that it's in it's in that direction. Now, it's impossible to say right now because yes, a country which is earning $70,000, $80,000 per capita GDP is unlikely to find workers willing to work for $20,000.
Seems implausible.
Yes, but therefore they will find workers willing to work for $0, which is basically robots with AI. Essentially, you just, I mean, robotic AI is basically where it's, I think, going because pure AI, white collar workers, robots plus AI, blue collar workers. That's how we sort of. So I think that's the path realistically where it will go in terms of implementation. But you will just tax different things and create universal income to take care of the population. And I mean, you've had the likes of Bill Gates talking about, we probably will need to work only 2 days a week or whatever. Maybe that's true. I don't know. We'll see.
Got it. So now the other side of this is, there's all this, like, do you see a possibility where, as things stand today, it seems a little unlikely that we do know for a fact that now this is an era of multipolarity, if you want to call it that. Like, do you see a potentiality where, there are alliances of convenience, like let's say, for example, US and Europe. I mean, the relationship looks rocky at this moment, but they have common force. You can call it China or whatever you want to call it. At the same time, countries like India have, relatively cheap labor. And they also have some basic prowess in creating, let's say, basic shells and armaments, etc. So can this potentially lead to this, countries like India, Philippines, your entire South Asian complex, East Asia, etc., arriving as winners to the extent that the bigger countries really want to offload the things that they can't really manufacture at home because of labor costs or whatever you want to call it?
So I mean, I don't know about winners or losers, to be perfectly honest, because I think it's too early to say that. It's like the game hasn't even begun yet. So it's very hard to say who will be that. But I think let's just touch on this multipolarity for a bit. Because you're essentially going to have multipolarity sort of, imposed on the world by default. Okay. Simply because the hegemon is sort of stepping away and wanting to focus more internally. There's a bit you talked about, that Taiwan, TSMC chips and all that. My sense is the actual opening of the plant and the working will keep getting delayed for a while. Because as soon as it's opened, what is the incentive for the US to protect Taiwan?
I hadn't thought of that.
Yeah. So most likely, whenever that happens, there's probably a signal China is actually going to take over Taiwan. So let's see how that. But yeah, coming back to the point, I think we're talking a multipolar world in the true context, which also means even from a markets context, we probably need to see it as a multipolar situation now. There are going to be multiple people competing for different things. And like I mentioned, it's the first time that you've had multiple countries in different stages of economic evolution competing for the same industries. That's not happened before. Okay, you always did that whole comparative advantage. What was it, Robert Maxwell or whatever his name? Whoever it was. Sorry, that guy's the poet. Yeah. So you do this, you do that. Now that's all breaking down. Everybody do everything, which probably may well mean, half the things will not happen. But that's again something a little further out. I think what it also does is definitely now seats the thing of, okay, if the US is not acting as the reserve asset, what's the logic of putting in then, I mean, US bonds and all that? They anyway don't want it. You never know when they go down yield curve control because something didn't work or when they need to, because, go back to that previous question we discussed that, okay, how do they actually construct and robots and this and that? I mean, if you're not getting robots right, what do? Just print money and make it right? So some version of printing money will probably come back in again, okay? Which then means if I have to think as a reserve asset owner, I'll anyway be worried about, maybe there's a near-term opportunity in bonds, but it may not sustain for too long if they are not able to keep inflation in control and so on. So, but at the same time, I also have to cater to my own needs. I mean, you can see the urgency building even in our government of trying to secure those critical mineral supply chains and all that. I think a lot of the reason they're sort of also going soft on the whole counter to the tariff dialogue is also that we want to be part of that access to acquire critical minerals and all these things. So which of course, if you get into that axis, then you're well placed. Because then you're sort of jointly bidding for assets, you're acquiring that, and once you do that, then there'll be automatic downstream collaborations also which kick in, right? But then that's the question of picking a side. We've never really picked sides. We've sort of wanted to be neutral, and so then the choice in front of us, or any other country for that matter, is also to take that call. Do I have the capability to be by myself and not be worried about anything, or do I need to pick a side and go down that path?
That neutrality is becoming increasingly difficult.
Well, unless you do something about building yourself up, right? I mean, the other way to say it is, it seems, there could be equally good logic for why we should maybe be partnering with China and Russia.
Absolutely.
Right? The resources also exist over there, the capabilities also exist, and they're closer to what we need.
Yeah.
As opposed to where the US is. So, all those arguments could come in. Now, I'm not saying whether we necessarily go down that path or not, but to your question that could countries emerge as winners, they simply decide which side do they want to pick.
Thanks for touching on the China thing, which was my next question, because I don't think this conversation would be complete without talking about China, because it's the 800-pound gorilla in the room, and it's also the one thing that kind of freaks me out is that at least the security establishment in the US has labeled China explicitly as an adversary. And that framing kind of leads you down a path which doesn't really look good. Because if you think that that country is out to get you, and then all your choices will be geared towards sort of a war-like situation. And regardless of what you think about Taiwan, regardless of what you think about China's rights, so on and so forth, it is undeniable that the West sees, or at least US sees, China as a principal adversary. And we were also, at least, you could argue, but India was also in that frame of thinking for the longest of time. But if you had paid attention to the recent moves, I think there is some softening on all those restrictions we had put in on China. I think last year we started allowing some of their employees into our renewables, because it quickly dawned on our people saying that we can't really manufacture solar panels and wind turbines like they can, because we simply don't have the technological capabilities. And the second thing is there is some thawing of relationships. There's back and forth happening between the B-level and C-level bureaucrats, etc. Do you think it makes sense for the likes of India, which is maybe a decade behind China, to simply leverage on their capabilities, because China is at the cutting edge of pretty much every other important thing that you want to go in that you would need in the future? And also at the same time, how does that map onto China's rivalry with US rivalry with Russia, Russia's friendship with India? Because this is a significant block no matter how you slice and dice it.
Exactly. So it's not going to be easy. So I think in this, it's also important to sort of lay out what is preventing us from going further up the curve. How many of those reasons are external, Trump, China, whatever, and how many of those are internal? Right. We sort of all know the answer, but so that's really, and I've been talking about this for a while. What we really need is supply side reforms. I think everything still keeps talking about need to improve demand, consumer demand, this, that. I think it's nonsense. You need to first get supply side really functioning. Yes, your returns may be subdued for a while, which is why I said project finance is more important than venture capital here. Returns may be subdued for a while, but that's where
ultimately it has to be a subsidy.
It has to be that. Yes.
China poured massive amounts of money with absolutely no returns, and then today they are in a position of self-sufficiency because at some level they decided to sacrifice that.
Yeah, so that's one. And secondly, look, now the tariff thing is the tariff journey is anyway out of the bag. So you can use tariffs liberally wherever you want to also. There's nothing stopping you for doing that. But at a level, you have to get your own production engines going. And for that, one doesn't have to think, to think that you'll be able to suddenly reach a certain quality, reach global standards, that's not going to happen. I think I'll give you a very micro example to say what I'm talking about here. I think just take what Rainmatter is doing with, some of those sustainable farming kind of initiatives. I think you guys are backing and, some of those things. Essentially it's production for a limited geography. I think just taking that thought and applying it both to agriculture, to essentially activities in the rural areas, to industrial production as well, and all of that. I think that's just it. I mean, it's fine that we are to get in maybe some part of solar technology which we simply do not have today. It's bizarre that we should be importing lights and lightings and Ganesha idols and all those kind of things. So, or basic furniture for that matter. Things we've had expertise in for a long time, and we've simply not been able to, put in our own self goals, which don't permit us to have scale industries. I'm not even going into the whole harassment aspect of it, but
Absolutely. No, just like extend that thought. Like, considering this very uncertain world, which is also weirdly in flux, because every day you wake up, something or the other thing, a significant thing would have changed. And it's very, very hard to find one's bearing of where this world is headed. But setting that aside, in this sort of very weird world, which is trying to find some sort of equilibrium, where does India stand? And like, what do you think India should do to find some sort of a reasonable place where it has some hope of finding some sort of success, no matter how you define it?
So I think, we get too swayed by a lot of these things. The reality is India's had its place for the last 6,000 years or whatever we've been around. So we just need to think that. I mean, that is not necessarily a case of, we've always been fairly inward looking, except certain periods where we were a fairly decent maritime power. Okay, we've otherwise been pretty much focused on ourselves. So maybe this is as good as a time as any to focus on ourselves. But I think our issue, is just far simpler. It's like, it's a lot of talk, it's very little execution. I think that's always been what has hindered us for a while. And to the extent we, again, sometimes that's what I look at as a potential silver lining in all that is going on, is that now we will very soon not have a choice but to act. Because the dices are going to be loaded against you in every way. Like you said, since we have not built ourselves up significantly, we are not really in a position to choose sides. And we sort of need both also. So we got to, play that game, but then it definitely means we need to act faster on our own internal capability building. It's as simple as that. And I think even a simpler, thing about it is, just go back to 2023 March. What did you do? You basically incentivized equities massively over bonds. But for a lot of this building, you need debt capital, right? That market's gone nowhere. All you really need to do is tweak the taxation there. And then suddenly you have any amount of debt capital will be available to fund whatever you need to fund. It's just about moving down that path. So at some point, I think you just take that call, hopefully.
Got it. So I think we more or less laid out the current state of the world. I want to get to the investment implications. But before that, I think this entire, the future of the financial system as we know it, I think requires a little bit of thinking through. So as you sketched out, this entire world order, from the post-World War period or even as far back as the Depression period has been more or less anchored on the dollar in some form or the other. Even when it was in the gold standard, it was still the dollar show. Whether the US chose it, I don't know if you know this person, Perry Murley. He had this interesting point. He's a dollar historian. He said that it's not really the US choice made in the Bretton Woods conference that cemented the dollar's position. It was the private sector's choice saying that this is the only currency available after the downfall of sterling that really cemented the But regardless of whether you choose that or not. So we had the dollar, which has been sort of the denomination currency for international trade. It has been the go-to choice for central bank reserves. It has been also the go-to choice, go-to investment asset for pretty much the last 20 roughly years. It's also the safe asset in all senses of the word, and leverage is built on top of the safe asset. So this is a finance historian and a professor. I think his name is Gary Gerstle. No, not Gary. It's some Gary. I forget his name. He wrote a paper saying that the entire history of humanity is a search for safe asset. And like no matter what you do, we need a safe asset because you need that store of value in the interim that you do something else. Otherwise, you put your money in Argentina peso too. You wake up in the morning, you're down 30%. So now, like you said, that arrangement is up for renegotiation. Trump really doesn't care whether the US wants to be a safe asset or not. But at the same time, we don't really have any viable alternatives, at least to my mind. So 60% of central banking reserves are in the dollar. 90% of global trade is invoiced in dollars. Maybe 30-40% of the entire Forex derivatives market is essentially dollars. There have been talks of this BRICS currency and all that. That strikes me as nonsense. Maybe, I don't know, some sort of synthetic currency with gold, etc. Like, how does this thing unravel? Like, what's the broad strokes? If assuming that this thing unravels, like, what happens? How does this entire play out?
No, I mean, we're talking a metaverse of possibilities here. But let's just park that a little down the road, simply because there is a path to get there as well. Okay. Let's first just focus on the dollar and what might happen. Now, in the very near term, what we've seen is the dollar's beacon. DXY down, whatever, 110 to 102 or whatever it is, right? Of course, this market turmoil has happened even when the dollar's actually been weakening, which is another, unusual thing. It's usually the opposite, right? But the thing is that even for the US to succeed in its policy, it needs a weaker dollar. What the US is really trying to do is take away the what you would call as the price insensitive buyer of the dollar. Okay, which is any reserve, reserve manager wanting to just park money in dollars. They're trying to take that away.
So we're essentially more or less talking about central banks, pension funds, etc.
Exactly. People who would just park reserve surpluses. So they want to take that away, and rather that money comes in directly. Okay. They also have natural resources within that. So it's possible that they may even say, okay, don't do this. I have lithium reserves. I have this reserves. I have reserves. You come and take a stake in it. I have gas reserves, come and take a stake in that. So all those possibilities open up. I'm talking about where do you go park money? I mean, that's essentially going into that aspect of it. So, but yeah, going back to the dollar, initially it has moved down. But as these tariffs kick in, and it's a bit of a work in progress, because obviously initially there's a bit of a shock to the system. Nobody is. I think today I read something that, okay, the customs is trying to clear whatever shipments as quickly as possible, so that, because the US as of now is saying, okay, what is already on the way, do it. But after this, going forward, let's say next 10 days after that, everything is sort of, on hold. So by default, the economy slows down everywhere. Okay. But as these negotiations may happen, all of that, but some version of the tariffs are going to be there. And as they sort of kick in, structurally, you reduce the availability of dollars around the world. So you will then probably see a phase where the dollar starts appreciating. Now, maybe the markets already anticipate this down the road, and they may start appreciating a whole lot faster than when the actual scarcity builds up. Okay. Now, for people to look for alternatives to the dollar, what you need is a stronger dollar. A weaker dollar, nobody cares. Everybody's happy with that. Okay. But the problem is, once you've gone down the tariff path and you're asking others also, to do different things and essentially build their own stuff, there's basically going to be a sort of competitive devaluation of currencies which could come into play.
It seems like it's already starting. I think the first move on the renminbi is starting to happen.
Correct. So renminbi is actually this time maybe actually even more than the renminbi. What started was the Aussie dollar.
Yeah.
And historically, Aussie and Canadian have been the sort of lead indicators for emerging markets, because emerging market currencies were a lot more illiquid. So people would trade the Aussie and the Canadian too. So it's already started. I mean, you're right. The Korean won is hitting a bit of a low or close to it. I think the yuan you anyway just mentioned. So I think that's the natural response which starts kicking in, which also puts the US in a bit of a tricky situation. Now, how do they then weaken it? And so they may make some noises on the other side, but tacitly, allow other things, which enable weakening over time. So those things may kick in, but you are going to get this phase where the dollar will strengthen. But then if that strengthening in some ways is something the US will also want. Okay, because it then opens up the possibility of arm twisting people using swap lines. Because there is dollar strengthening, there is structurally where you might go using alternative solutions down the road, but the alternative solutions may also take 2-3 years. there is interest payments you have to meet now. So for which you will likely need, swap lines, which the Fed will activate and weaponize and say, okay, I'll give you a swap line, give me this. So, whatever, something like that happens. Okay. That then opens up, okay, what happens next? Now, if you're the US, you would still want some version of it to happen, right? I mean, you would still want the dollar to be the currency which people transact in. Okay. You may just not want to take the headache of paying them an interest on it. Okay. Which means the logical path for the US is probably stablecoins.
That's interesting.
Right. So, Bitcoin may just be the headline reel on which all of this is, sort of legitimized. But the fact also is the likes of Fidelity, BlackRock, and all have been investing into building digital custody businesses for significant amounts of time. And people don't do that unless they know something's coming, right? And at that scale. So I think that would be the path for them, because that's essentially just acting as, one way to transact all around. So keeping that, but then I don't have to take the headache of managing your reserves, paying you an interest on it or anything like that. It's just a tracking mechanism, and that may work for otherwise, because you're right that unlike when the pound transitioned to the dollars, where the dollar was there to take up that thing, there is no real alternative to that. Okay. Now that's what they would want. And this is where the bifurcation of the system may truly happen. Because today, the way the system is, it is basically a US run world. The real economy, again, US is the biggest consumer, whether it's the financial, they're anyway controlling all the strings in that, or even the technology world for that matter. The only person who sits outside the US technology world is, surprise, surprise, China, right? But they don't sit outside the US financial world. Okay. So to what extent, and for them, stable coins may be a bit of a reach. That's probably not going to happen. But direct bilateral deals and, digital currency, digital payments, settlement between central banks directly, which is the whole CBDC.
Interestingly, I don't know if you noticed it. I think the last 1 or 2 days ago, they announced some digital yuan. It was already there, but they said that they're going to extend it to something. I forgot to read the news, but it's more or less what he said. So they'll start using it to settle their transactions or something.
They've already been using it, to be perfectly honest, because we got to Kenya about a couple of years back. There was this highway which had got constructed there from the airport into the city, which everyone raves about because it says cut down times and all that. Now, the highway was built by the Chinese. The toll collection on that is done by Chinese companies. Now, interestingly, I mean, not like there's officially anything, but so Africa, everybody's on that M-Pesa or whatever, that equivalent thing, right? Which everybody works on, which is basically run by that mobile thing, which is run by the African telecom companies. Okay. But in this case, the payments are not made through M-Pesa or whatever that word is. It goes directly into some Chinese account and is wired directly into China. Like it basically goes into some
so
China.
It's pretty much like a straight line through between their system.
Exactly. Yeah. So that's already in place. So maybe, things like that. I don't know how many of those kind of things they've already got operational. So those are probably their sandbox pilot projects, which they're already doing to do this. And I think that's what they'll do. Because if you're a big trade partner, they're the one calling the shots here. Right. So they could easily, just set up those direct settlement mechanisms. I mean, a variant of our rupee dollar this thing. I think Sridhar Vembu is talking about it in a tweet today. I mean, it's an interesting one. I mean, we still don't have the capability to enforce all that, but China does. So whatever he's talking about, China can actually execute on that today, which is basically getting others to pay for things in your currency and directly sort of having transactions in your currency and just enable it digitally. Let the two central banks settle it between themselves, which is basically an excuse to bring in CBDCs. Every government is going to love CBDCs in this world. Now, whether it'll come in or not come in is a different matter, but they're going to love it. So probably that's the path.
As this entire, let's say, the future role of dollar is shaking out, there's bound to be repercussions, there's bound to be tremors in the financial world, because this would mean that an asset, an X asset that you had used as the base layer of your leverage for the last X number of years is no longer not only a reliable asset that you can use, but at the same time, it would potentially be far more volatile than a penny stock. So that means there will be ripple effects in terms of leveraged unwinding. It could ripple out throughout other asset classes, because today, more or less, you might disagree, but we are a global capital market with very thin walls between one country to the other. So what does this mean for the financial world?
Yeah. No, I can, again, over here, I can only speak for what I'm doing, to put it. And it's been my thesis for a while, even when I'd started the earlier PMS 4 years back, was that with essentially financial repression and versions of national capitalism coming in everywhere, it's just you needed the Trump characters to push it along, but it was always going to be there. And multiple countries wanting to, protect their own turf and all that. Forex volatility is a given. And if essentially you're stepping away from the role of being the reserve asset provider, which had already incidentally started after they confiscated Bank of Russia's assets, the transition was already starting. We don't know what the next reserve asset is going to be. So that is up for grabs. The reserve currency is another dynamic, but we don't know what the reserve asset is going to be. So therefore, in the transition period, you essentially just think of it in a very simple way that, okay, tomorrow, if money had no value, what would I do? I would secure my food and water and all that supply chains. I would look to, acquire whatever critical resources I need for building my industries. I mean, here you've been forced now to build industries also, so you'll probably need that. And whatever neutral assets like gold and all that, maybe crypto, whatever, they do that. And then I build on that. So that is my intent. Now, I don't know what the final thing is going to be, but then if we think ahead digitally, tokenization, all of that, there doesn't need to be one final thing. I mean, you tokenize it and, things start happening.
Got it. So, I mean that makes perfect sense. It's very hard to put your finger on what's going to happen. So now, I just want to tie this all together in terms of investment implications. So the last time we spoke, you kind of mentioned that it's very likely that we'll have to make peace with lower returns because of some of the potential policy choices that some of the countries either willingly make or will be forced to make because of geoeconomic considerations. As all this happening, be it tariffs, be it national capitalism, be it onshoring, defense spending, green transition, potentially higher inflation, and whatever is about to happen with all those deficits, etc. How do you see this translating into the investment decisions either you make or you recommend some of your clients make? What does that mean? How do you think about that question?
So let's again, just put down various levels of the Jenga block here.
Absolutely.
Right.
There's going to be a long answer.
Yeah. No, I mean, I would be fooling myself if I say I have a perfect answer for this, but I'm just trying to layer it out. So first part would really be that, okay, last 15 years, broadly capital around the world has gone into US stocks predominantly. Till 2020, it was US bonds. And then once they hit their lows, it was pretty basically US stocks. Okay. And while what we refer to in the dollar, that yes, initially, yes, it's weakening, but chances are after that it strengthens over the course of the year. But then after that, structurally, the dollar has to go down. Because if less people on the margin are buying it, and even they need a weaker dollar, it doesn't make sense for it to keep going up. So, and at that point, and that may be a year out, or we'll see when that happens. And before we get into all this tokenized world and all of that, which may be the future, but it's still going to take a little time to get there. You probably are first dealing with a reallocation of capital.
Seems to be already happening with that Europe trade, etc.
Well, that is already exactly the point. So now reallocation of capital also in multiple forms. I think there's a shorter term thing which is mostly from equities going into bonds. Okay, there's a certain amount which had been going into dollars anyway. Commodities go okay, maybe selling off. Maybe there's a bit of a final fall in commodities, which might actually be going on for all we know. But let's see how that happens. But yeah, but then unlikely that there's going to be a huge amount of follow through in bonds beyond a certain amount. Okay, it may be a trade for this year, but I don't know if it's necessarily beyond that. Okay, because national capitalism repression is basically bad for bonds, whichever way. So, so yeah, now comes the reallocation of maybe the equity pool. Okay. Now, if you're also going with the thesis that chances are we're running into a multipolar world, safe to assume that we will also be multipolar in terms of equity allocations. Okay, so which doesn't mean that there is one answer, there are probably many. So then you break it down, okay, who are the markets who can take in or absorb larger amounts of capital? Because you're talking of a whole behemoth from which money may move out and go elsewhere, but somebody has to be able to take it. So yes, your four biggest markets are probably, Europe collectively, Japan, India, and China. Right? I mean, China is probably the biggest of the lot, but
not many other countries can accommodate whatever is about.
But at the same time, China may have some issues of, the worry on what if it's the next Russia in terms of blockaging of capital and all that.
Right.
So that could create. So Europe, of course, becomes a big pool, but then Europe is Europe. So people will really need to see action there before they do that. But you could at least have initial. So what could happen is, Europe still has a lot of business families, right? I mean, now, if you are in a situation where your countries are now forced to invest more internally,
right?
Okay, a lot of those business families will come in as providers of capital.
Yeah.
Because essentially the government will want them. They'll probably get some sort of, quasi-assured returns.
Yeah.
And for a family which has a few billion in assets, if I'm getting 10% assured or whatever, I mean, I'll take it. Right? I don't need to take all the headaches. And look, part of it is going to be coercion, part of it is going to be persuasion. So whichever way it happens. So we probably see that. So these are probably the four biggest markets, but then fairly close to it, you also have the likes of the UK.
Right.
You've got the Brazils. Canada is a fairly big market. Australia is not too small either. Korea, Taiwan are reasonably big. So I would say Saudi is fairly big now. So the four biggest ones, and then maybe 5 or 7 of them after
satellite
that.
positions.
Satellite. They're also fairly big. They're not that small.
Yeah.
So I think a reallocation is now going to happen here. And this is where I'll come back to the point I made, that for the first time in whatever history that I know, is that multiple countries are competing for the same industries at the same time.
Absolutely.
At very different stages of their own economic evolution.
Yeah.
So now, who's going to ultimately succeed? No one knows.
Yeah.
So ultimately, right now, it's more capital will sort of scatter around, find its way. And therefore, we also will have to start competing for that capital.
Yeah.
So, this whole natural expectations that just because it is stepping out of the US and it should come to us is not really the thing.
Yeah.
It may go in. And in any of the discourses I've heard from people not from India, India doesn't feature in that piece of reallocation of capital.
The gap between narrative versus the flows is it's humongous.
Yeah, it just doesn't feature in the piece. I think China is definitely in the piece. Europe's in the piece, UK is in the piece. The others, the likes of, if you want resources, then automatically your Canadas and Australias come into the discussion. Japan's in the discussion, definitely, because a lot of interesting, I think on the technology side, there's quite a bit which is there. So that's the what we're dealing with. Now, again, the reality of what may happen is about 5 years out, which means for the next 4-5 years, the markets are likely to trade on perception. Now, the problem with trading on perception is that your views will change overnight. Okay, depending on, news flow, of course, but even more so, gamma positioning, all those things will, matter. So you're probably faced with a scenario where things will, just what we're even seeing in the Indian markets, right? It's sort of rapidly rotating between sectors right now. So it's very hard, to really bet on what's the right thing and what's not. You may have a position on, but, you went somewhere, you came back and suddenly everything's gone topsy-turvy. So now imagine that happening all over the world, right? Because typically these country allocation decisions used to be taken in January. You had to think, okay, this bucket, this for this thing. But now suddenly you've already, quarterly is a bare minimum. It may happen even faster, right? So that's the reality we're dealing with. I think, obviously, I think project finance, physical assets, all of that in multiple countries become important in this. Now, if you have the capability to do that or not, really depends. Okay, so I think these structured deals, which I was sort of referring to, I think those become big pools of, or suction pumps of capital in a way.
That's essentially on the private side.
The benefit of the private side is there's no mark to market, so that helps. You have to worry about illiquidity on the other side, but yeah. So pick what you want to. So I think that's there. So, but that's the intent. Now this crazy movement of money is sort of what we're talking about. I mean, of course, it will wear down people like us, because how exactly, how do you keep moving? And if in the process of doing that you're still not making money, there's a high probability that happens, but then ultimately at some point you give up and like, never mind. That's just.
I have a feeling the number of white hairs on your head is going to multiply in the next 6
obviously,
months.
It will. So the more you act, the more you're likely to. I mean, you will need to act also, because the grounds will shift quickly.
I think you might know this lady, that Lynn Alden. She's pretty popular. She said something interesting. She said there's a headline-driven market. Like essentially something we said. So you are just essentially trading on headlines and not really based on any other fundamental thesis.
So that is one. So either you do that, or you sort of shut out the noise in a way and then figure out, okay, these are the set of things. Maybe narrow down your scope of what you want to do. And maybe not try and trade the whole world or everything, and just narrow down, okay, these are the things needed and let me focus on that. I think it may ultimately come down to that, because anything else is not humanly possible. But then we've reached the stage where maybe humans may not matter so much in a few years. So that's another Pandora's box. We
That makes sense.
Get into that. But I think realistically, and this, let's paint the story a couple of years or 2-3 years forward. Maybe topical the way Nandan came and talked about all this tokenization, unlocks and all that, and which is really the forward versions of India Stack. That's exactly what he was talking about. So in a market where, today we're probably at peak global thinking on markets, right? In a way, like everyone has a view on everything at the moment. And in a way, nobody has a view on, nobody really knows, right? So, but fine. We may or may not believe Nandan today or whatever it is, but if we were to just take that thought for a while, that even something as simple as tokenization of real estate, it's not implausible, right? If you want to move down the path, that may exactly be, and he's right. It actually could unlock entrepreneurial capital and sort of, really open it up. And even like all the plantations you guys own or whatever else you guys own in Rain Matter, tokenize it and trade bits around it. I think
weirdly that was the initial discussion when this entire thing started, saying that could we allow people to own a piece of it, given that we were a capital markets business.
That's what's going to happen. I think the capital markets business is going to transition from where we are right now in dealing with complete intangibles to something more focused and on so you sort of break it down into lines of business within a company, trading those pieces. It could be a whole bunch of things, a lot more localized, but still maybe at population scale. And I think that's a whole, thing. But I think it will need to move down to that path, because that's also the easiest way to finance what we are truly trying to do, which is, have more local manufacturing, have more local production, better supply chains. And I think the solutions need to be sort of local, global combined, for those things. So, but that's a little way out. So it's the interim management, which is the challenge.
So this is more like a question for people like me. I don't think this matters to a money manager like you. For the past, call it whatever, 3-4 decades, I wouldn't say spoiled, but we've been conditioned into thinking, saying that you just put your money monthly into this thing, just buy and die, things will work out. You just own 3 or 4 pieces of XYZ. And it has worked. No matter how you measure it, it has paid off. And especially in the last phase, it's paid off even phenomenally well. But in the world that you sketched out, it seems like it at least seems like that thinking needs a little refinement, in the sense that it's not that you shouldn't buy and hold, but at least it needs to evolve in line with the times that are about to come. So if you were to put your advisor hat and give advice to somebody who wants to allocate his monthly savings, monthly surplus into the capital markets, like what would you tell that person in terms of how to update his thinking, which has worked in the past but may or may not work in the future? Like, what's your sense?
So I think, chances are we have a more volatile world. There's no doubt about it. Trading the headlines, as you referred to. But I don't think that's actually practical for a whole lot of people to, trade headlines. I mean, maybe they build those AI agents to do all that, and good luck. Maybe that works. And there's a bunch of people, I guess, doing versions of it. Let's put it that way. So I think what you really do is keep it fairly simple, which is sort of divide the money between, say, 4 or 5 big pieces, right? Okay, so let's say what I mean is 20% equities, 20% bonds FD, whatever, 20% gold, and the other assets you want to own, real estate, I guess, comes into that. 20% more, which is just liquid cash for opportunities which come from time to time. I mean, whichever variant of it, 20-25%, basically getting allocated between those 4 or 5 different pieces. Okay. What it then does, it sort of gives a certain amount of stability. It's actually worked also even in the last few years. Yes, no doubt your equities did well, but just a second. Yeah. But this year, bonds have also, sort of done fairly well. I mean, yes, on a post-tax basis, they don't look great, but then taxation for a bunch of people is also changing. So bonds have done reasonably well. You've got this scenario where gold has done fairly well in this period. So I think things will keep moving around. So that's probably the more practical solution which you may have. And then, keeping that chunk of cash aside, that 15-20%, whatever it is. I mean, outside of what your daily needs are. I mean, I'm keeping all that away, just investment pool. So keeping that 20-odd% of cash available for, tactical deployment as and when the opportunities present themselves. That may be the more practical way to play this whole, quick shuffling between various things, as opposed to, trying to guess where what will happen. And then it's easier for you to then continue doing your monthly allocations as well. Your paycheck is coming in and you're allocating from that. I think it may be easier to manage in that way. And of course, Nandan will then give you the ability to buy pieces of real estate as well.
No, it makes sense. So, I mean, that was a phenomenal tour of the world that's changing. So thank you so much for doing this. I think we more or less covered all the big pieces. I think some of the things that could have got to dive deeper, we'll keep it aside for the next conversation, because I don't think this...
Yeah, it's quite a bit already.
Yeah. Entertaining world is not going to end, so I don't think we'll be starved for topics to talk about. So I'll pick your brains in a few months when we are in 2055. And then we'll pick it from there.
Sounds
Thank
good.
you so much for doing this.
Okay. All right.